A public limited company is a type of business that is owned by shareholders who have purchased shares of stock in the company. As businesses grow, they may look to the option of becoming a public company as a means of increasing their number of shares and access to more capital. These shares can be bought and sold on a stock exchange, such as the London Stock Exchange, Australian Securities Exchange, or the Nasdaq. For example, once the business is listed on the Australian Securities Exchange, the shares in the company can be openly traded and bought or sold by the public. This also means that the company's ownership is spread out among many different people who own shares, and the company's stock price can fluctuate based on factors such as its financial performance and overall market confidence. Public limited companies are also required to disclose financial information to the public, which allows investors to make informed decisions about buying or selling their shares. It's important to note that private companies go public in order to generate capital to help further their growth, reduce debt, or fund other business operations, and many large and well-known companies, such as Apple, Amazon, and Coca-Cola, are publicly listed companies. Public limited companies are required to hold annual meetings for shareholders, where they can vote on matters such as the selection of board members and executive compensation. Taking part in these meetings gives the shareholders a say in how the company is run and makes the shareholders the owners of the business. Going from a private company to a public one is known as an initial public offering and comes with both advantages and disadvantages. The advantages of public limited companies include limited liability for the shareholders, as shareholders are only liable for the company's debt to the extent of their invested capital. Public limited companies are able to gain extra capital through selling extra shares, as they can raise capital by issuing new shares, which can be used to invest in new projects and expand the business. Public limited companies have separate legal entity to their owners, meaning the business can take out loans under the business name without impacting on the shareholders' debt. The business's existence is not threatened by death or removal of one of the directors or shareholders, meaning a public limited company can continue its existence regardless of changes in ownership. Public limited companies have easy transfer of ownership by selling and buying shares on listed securities exchange, allowing individuals to easily buy and sell shares on a stock exchange, which provides ease of ownership transfer and liquidity for the shareholders. Public limited companies often have experienced management team on board of directors, as they are usually managed by professional managers and have a board of directors that oversees the company's operations. In Australia, company tax rate is lower than personal income tax rate, as all companies are subject to a federal tax rate of 30% on their taxable income, whereas income tax rates are based on tax bracket depending on your circumstances and the income generated, with the highest tax rate being 45% for people earning $180,001 and over. However, there are some disadvantages of public limited companies, and they include highly complex business structure, as a public limited company structure involves more complex management than other business structures and requires its operators to understand and comply with all obligations under the Corporations Act 2001. High establishment costs when listing a business as a public limited company, which includes legal, accounting, and underwriting expenses, making it an expensive process to become a public listed company. Public limited companies require greater accountability and compliance to help protect shareholders, as the legal and regulatory requirements for a public limited company are more onerous than for private limited companies. Public limited companies also have additional compliance costs, such as quarterly and annual financial reporting, which must be audited by independent auditors. Auditing by independent firms can be costly to prepare, along with the fact that publishing poor financial performance can lead to a loss of shareholder confidence and drop in the value of the company's shares. Overall, public limited companies are usually multinationals and have thousands of employees, and their products are consumed by millions of people around the world. As public limited company is a type of business that is owned by shareholders and traded on a stock exchange, they are subject to government regulations and must disclose financial information to the public to protect the public from misinformation. Investing in a publicly limited company can be a way for individuals to participate in the growth of a company, but it also carries risks. As such, it's important to weigh up these advantages and disadvantages before deciding whether to start a business as a public limited company or investing in one. It's also a good idea to seek professional advice from an accountant or solicitor before making any final decisions. Thanks for watching, and if you have any further questions about public limited companies, please don't hesitate to reach out to us in the comments below.